Hello traders, Gary Wagner here. It is approximately 11:45 in Honolulu, Hawaii. It is Tuesday, the 30th day of August, and this is the daily report for gold. We have gold with a substantial rally today, well off the lows, currently trading $1834.85, up about $45. The big news right now is that Chicago Federal Reserve President Charles Evans said that further measures to stimulate the economy could be necessary. That created an incredible bullish rally in the gold market and was the fundamental impetus to move it off of these lows today. Strange days indeed. Traders, as we currently sit, I believe we're in an absolutely critical area within the marketplace itself. Although I currently believe we are in a ABC corrective pattern, that we are in a corrective phase, there can be no doubt that the fundamental factors that have been driving this bullish gold train have absolutely not changed. My question therefore becomes, this last correction, can we look at that as a possible C? And to do that, I've got to look at a lot of pieces of data, but the first thing that I do want to look at is a Henkin chart. It's in a 120-minute time frame. It does have our moving average convergence divergence below it with Fibonacci retracements in it. The reason for bringing this up is as follows. If we take a look at this big picture and we have our long fifth wave up, we have our corrective A wave down. That seems to be quite clear. That's pretty easy to pinpoint and to look at the various pivots. When we take a look at where this market actually fell and we look at this bottom here, it will take us to a 50% retracement of the beginning of the move that we witnessed back in January. So to do that, we can simply reduce this chart and then take a look at the beginning of this actual move and enter a Fibonacci retracement. And if we do that, we're going to be looking down here at the bottom. We take it up to the top. And traders, as you can see, our 50% line, 1694, the actual low right around 1700. So you can see that that's actually pretty much in line with the type of retracement we would get. So I am actually very comfortable with our current A wave. However, when we take a look at this last move, this is our B wave coming in right here. Typically, a B wave will fall between 50% and 75% of the move that you saw in A. And as you can see, it falls just at a midpoint of that. So that seemed logical. Now, yesterday we did get this sell-off, and if we look at this sell-off is a 38% retracement of this recent rise, this rise in what would possibly be B. However, we get the market, we get this huge rally today, and we also see that this rally typically stalled. It hit this double top right here at 1838, and that's vis-a-vis the cash market. What I see looking at all this data is as follows. One, we can absolutely see that we have a double top in here. We also have a pennant formation forming. However, at the same time, we have the MACD, which has actually turned up. My belief is that the highest probability is still that we're probably still in our B wave, the ascension up, the counter wave in a corrective wave, and we still have a distinct possibility to have one final leg down, that leg down being the conclusion of C. At the same time, one must ask, could this possibly have been our C wave here? If that's the case, and we'll know as we historically view this, it would be the shortest correction in history. And therefore, to me, until proven otherwise, I believe that we're probably still in B. Now, how would that be negated? Well, that's quite easy, because what would have to happen is The highest level in terms of parameters comes at around 1860. 1860, if we would see this market move above that point, then we categorically would be out of a B wave, because the B typically will not go higher than 75%, and it's more to be somewhere in this range. Right now, we do have this double top, so that if the market begins to track a little bit lower back here and then breaks above, then we've got a true breakout to the upside, and that would tell me that even though it seems highly unlikely and extremely rare, the fact of the matter is that retracement was probably the shortest C wave in history. The facts are not completely in yet, and for that reason, my belief is that we are at an absolutely critical area because of the power that's built in any type of a pennant formation, such as this. I also believe that the best advice we can get right now is one that would keep us out of any kind of a trap. There can be no doubt that when you're in these types of corrective phases, the market is extremely difficult to call at times. When we're in a pure impulse phase, it's much easier to look to buy the dips and then sell at the ends of the rally and look to go back in as it runs through impulses 1, 3, and 5. This, however, is a critical point within the market. And because of that, I need confirmation, and I really want to see how it reacts right within this area here, and from there we will define our next trade. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.
Strange days indeed. Strange days indeed. Many sights to see. And when I look in my window, so many different people to be, that it's strange.